Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I'll just let you have a quick look at the disclaimer, I'll just run through a couple of things to do with the webinar. In case you haven't tuned in before, I do see quite a few have already, so that's great for us, and really do appreciate you following the webinar for the next 30 or 40 minutes or so. We'll just follow the normal format actually, so we'll just check out how markets are shaping up currently. We'll just check out the US election, actually, which is obviously getting a lot more exposure now with only a couple of weeks to go now. And we'll just have a look at some of the trades that have been picking up with the odds slightly of a Trump presidency increasing. It obviously depends what you're looking at to follow the polls and so forth. And we'll just run through that briefly, just obviously with a few weeks to go. We'll also look at Tesla. That is the main, the big earnings release of the week. Before then, looking at a review really of the ECB meeting from last week, really crucial for euro dollar for sure. So we're going to that into some detail really. We'll look at the UK data as well, important for the Bank of England and sterling for sure. We had CPI data in amongst wage growth data as well, but that CPI data was really interesting and potentially an issue for sterling, actually, in more gains, especially against the dollar. We'll then briefly look at I've got PMIs in here, but it's actually CPIs, sorry, from last week. So we'll look at the Kiwi and also Japan CPI and dollar yen as well. Apologies for that. It's CPI review because we previewed those last week. So we'll look at all the associated currencies to do with these data points before then looking at this week's main events, probably the Bank of Canada meeting. Interesting 25 or 50 basis point cut. A little bit of discrepancy between analysts really and money market pricing. And we'll look at the PMIs as a lead indicator, of course, for most economies. And certainly that was cited by the ECB as being a key reason for them cutting again. Okay, firstly, just checking how markets are shaping up currently. Just before I get to that, actually, I just want to say, please do ask any questions along the way in the chat box. Really more than happy to answer any question, however big, small, on fundamentals, on anything you're reading, on any trade setups as well. Yes, very keen to help you with those. And please do, ask along the way, and I'll hopefully answer them, or at least at the end of the webinar. Just checking out markets are currently shaping up. Dollar modestly bid, really. Sterling closer, getting closer to that 130 handle again. Big sort of area of support, really. And we'll look at that shortly when we look at the UK data. Dollar yen kind of near 150 again as well. That was obviously a key sort of line in the sand, if you remember, quite a few months ago. Obviously, we broke that wholeheartedly, but again, people citing 150 as an interesting level for Japanese authorities. And there are levels just above that as well. We'll look at dollar yen shortly as well. The euro just above last week's low, actually, currently 108.10 that was. And the CAD, Canadian dollar, that's near long-term lows actually now. So dollar CAD near long-term highs, actually, just ahead, of course, of the Bank of Canada meeting on Wednesday. Commodities, really interesting. Obviously, with gold, we're 10 months into 2024. Really, gold has rallied 30% now. One of the more commanding stories, really, in commodities this year, breaking all-time highs again and again. Obviously, the gold broke through 2,700 on Friday, fresh highs today. Really driven by multiple factors, really. Haven demand, of course, on the Middle East tensions, US election uncertainty, no doubt. There's a de-dollarization theme. amid sort of growing concerns really about a rising US debt pile. And then there's obviously those longer term kind of fiscal policy worries, which then sort of feed into that de-dollarization theme. And then, of course, we have a sort of US rate cut idea, although slightly pared back recently with obviously the strong data that we had consistently had now. And we had retail sales last week as well. Technical picture, actually, if we just pull up the gold chart, actually, we should do just to show you where we are. Obviously long-term highs, all-time highs, sorry. So not much to say technically, but you can just see we're overbought on the RSI there, the daily RSI, and also on the weekly, very overbought on the weekly. You can see there, that's interesting. So just watch out for possibly a correction. I normally have Keltner channels actually, which you may or may not know about. And these, if I just bear with me 1 second, you can just see, you can just see we're at the top of the upper band. These are similar to Bollinger Bands in a way, if you think about it simplistically, but you can just see, interesting actually, we can obviously go through the upper band quite a lot, as we sort of saw earlier this year. But at some point you do get a pause. So here, for example, May, we went through the upper band and then pulled back quite nicely. Again, we sort of have moved up through sort of autumn and then sort of corrected eventually. But it does tally again, always use sort of several indicators, we would say, for your timing, of course, in putting on or taking off trades. But just as a guide, you can see, again, we're through the top band of that Keltner channel, and also we're overbought on the daily RSI, for example. That's in gold. I wanted to get to then other markets, of course. 10-year treasury yields, they're always important. We always say this. It's kind of a proxy for global borrowing costs, essentially. That US 10-year treasury, if we just briefly look at that, because obviously it gives you a guide to the dollar and to the Fed, of course, as well. That's normally, typically, you would think of the 2-year yield, and that maps closely with Fed funds futures. And you can see that pick up dramatically, obviously on non-farm payroll, and then we're just below 4% in the 2-year. But the 10-year, I just wanted to show you, interesting whether we're going to break to the upside here. You can just see overbought conditions, really. This is the yield, remember, so prices going lower, yields go higher. Overbought on the yield, just pulled back nicely back again. The gray line is the 21-day moving average. Actually, it's not. It's the 100-day moving average. Apologies. You can just see then hovering around there and then potentially moving higher again now for the 10-year US Treasury yield. Again, that may have implications for the dollar, as I say, help the dollar, support the dollar for sure. And we'll get into this with the Trump trade as well. Otherwise, I want to just show you, well, just looking at other markets, currencies, as I said, the dollar's modestly bid. We'll look at that shortly, the technicals anyway. Equities, yeah, Asia, narrow ranges really, except for China, which gained after the bigger than expected rate cut. That's all part of their stimulus measures. Interesting reading, really. Some people now saying that it's not really the whatever it takes moment, and potentially there may be less stimulus than thought. We do have another meeting, I think, next week, possibly with the authorities, press conference, that kind of a thing, to highlight what stimulus is coming again. For stocks on Friday, well, the NASDAQ, S&P 500, Dow, they reached their 6th consecutive week of gains. Investors really rallying behind tech stocks again. Both the S&P 500 and the Dow reached record closing highs. Rally in part due to Netflix really soaring over 11%, better than expected third quarter sales, profits, and subscriber numbers as well. So that was a real boost to tech, of course. Apple added over a percent actually on reports of stronger iPhone sales in China. Flip side, really, Procter and Gamble, they fell slightly after missing sales forecasts, and Amex, American Express, they dropped over 3% due to lower revenue. I want to get on to Tesla and just show you that chart, obviously, with those earnings coming up just before looking at the indices. You can just see, if I take the Keltner channels off now, actually, you can just see this is a consecutive days of gains, really. It's not really a technical indicator, but it can just show you when we're sort of out of line with how many consecutive days of gains or losses we have, and possibly if there is a change, again, you would use that with other indicators, or we would for sure. But Tesla, you can see just hovering around that 100-day moving average and this Fibonacci level. That's at 220 and the 100-day moving average at 218. Interesting. Longer we track sideways, the bigger the breakout will be, and for sure that event is no doubt on or due to happen because of the results which we get after the US close, just a note, on Wednesday. Stock price obviously will get a lift if we beat analyst estimates. It has fallen short actually of these for 4 straight quarters now. Key things to note probably for us: sales guidance around the Cybertruck will be important, potentially building on its faster selling start. That's been positive, really. A boost from any China recovery should also bode well, as EV sales actually grew for the first time in months in the last quarter there. Of course, we did get this recent drop of over 12% actually after Tesla unveiled its long-awaited robo-taxi. It didn't really provide any details on really how fast it could ramp up production or deal with any potential regulatory hurdles. So, of course, any news on that, more news would be of interest. Otherwise, key levels of support, you can see if we do break down then, and we do expect this to be a breakout because we track sideways, then we've had sort of contractionary ranges. So essentially we will get range expansion soon, we would think. I think it's interesting. Options roughly give around a 6% or so move of a move up or down, that is, which is relatively small post a earnings release day, but it is, just to reiterate, +6 or -6% up or down. That's what options are pricing in for this move after the earnings release. As I say, 218, we've got sort of this zone of support, really. Upside level would probably be 240, so that minor fib level, which sort of tracks with these lows that you can see in October and, of course, in July. Otherwise, downside support, the halfway point of this April move higher from the low up to the high in July, that's at 205.03, and then you've got the 200-day moving average as well at 201. You can see that black line there. So that's Tesla. Otherwise, just wanted to get into actually, just as I pull up a couple of stock charts, just actually we'll look at the stock charts first. You can just see, yeah, long-term highs should really get rid of that Fibonacci level. We're not overbought, you can see, which is interesting, and we've said this consistently actually for the last few weeks. Just looks good technically, as long as we broke that sort of previous high, then that looked good technically. We weren't overbought on the weekly, and again you can see on the daily just edging higher. Nothing too major, which means we're not overbought. We're just going modestly higher with bullish momentum, really. So again, all-time high, all-time intraday high, 558.78, you can see there. So just mark that out, but does look good for more upside. potentially into the election. Nasdaq slightly off its record highs, you can see. So last week's high was at where are we? 20,493, and then the all-time high from July is at 20,682. Otherwise, possible support around sort of 20,000 or so. You can see on the Nasdaq. The Dow, obviously, all-time highs again closed at, and yeah, intraday high actually as well. So 43,325 was the intraday high. Just closing in on sort of overbought territory, but nothing major. So looks like direction of travel is fairly obvious, potentially. Yeah, just regarding the election, then certainly that is probably helping stocks. Polls have tightened further. They're actually at their closest since midsummer now, probably after um, uh, Kamala Harris got the vote, obviously, and had that bump, that boost in her chances of winning, and that has now narrowed. And as I say, closest since midsummer aggregator, which is, well, we look at various indicators really. So there's a couple of aggregators. That's the 538.com website that helps, and then real clear politics as well is what we look at. In amongst a couple of other areas, Polymarket as well, that is interesting, although potentially that is helped by blockchain, so could favor Donald Trump, of course. But then on the flip side, you do have Predict It, which is possibly people say a haven for academics, so is more liberal, so would tend to go for Harris over Trump. This probably digress on what we look at, but hopefully that's of interest to you guys. But for sure, election polls have tightened, as I say. That aggregator 538.com shows Harris now only leading Trump by, well, less than 2% now. It should be noted, though, that a very popular close vote, popular vote points to a Trump victory due to, of course, the US electoral college system for choosing the president. That's what happened in 2016. Despite trailing, Trump was by over 2% actually in the overall vote. Of course, he eventually won. We mentioned Polymarket. That is, well, a betting odds site, basically. And that's those odds of a Trump victory have widened quite substantially now. They were kind of 50-50 or thereabouts just a few weeks ago. Now, Trump, I think, above 60%, so 60-40 in Trump's favor in those betting markets. Though a little caveat there, the Wall Street Journal actually ran an article late last week saying that just a handful of accounts have been placing massive bets of similar amounts, actually, around $30 million in crypto in favor of Trump winning. So that might have skewed those odds, and just something to bear in mind if you do follow that indicator. As for I said we get into sort of what has been happening in markets, then the themes around Republican winners, they have outperformed Democratic winners. And I think in one investment bank in their portfolio of those, those different segments, if you like, has outperformed by over 7% over the past month. So cryptos, small caps have performed better, while renewables have underperformed. And those are obviously crypto and small caps favoring a Trump victory. Renewables, obviously, more for Harris. In addition, the wider US equity market, that obviously, as we've shown you, continues to make all-time highs. Positioning appears to be elevated. And really based on the thematic shifts, kind of historical returns around elections, and also that elevated positioning, if you like. There is room, of course, if the odds start to shift the other way in the next few weeks, then there could be a bit of disappointment and reversal in those moves that we have seen recently. So small caps, crypto stocks have performed very well the last few weeks. Renewables, of course, have underperformed. Just for your note and a wider guide, really, S&P returns have tended to trend lower in the weeks heading into the election. They're muted really in October during election years, actually since 1950. So just bear that in mind, of course. But banks, cyclicals, sort of consumer stocks and growth stocks are sort of favored in a Trump victory, and banks especially performing well. Whether that's to do with results, of course, we don't know. With earnings results, that is, doing well recently. Kicked off the earnings season, of course, last Friday. Otherwise, just checking actually. Otherwise, yes, for currencies then and for the dollar with the election, really the most bullish dollar outcome would be a red sweep. And then the most bearish dollar outcome would be a blue sweep. Red sweep being Republicans take both houses, blue sweep, obviously, Democrats take both houses. That's seeming as very unlikely, the blue sweep, just because of the electoral college and the system. The magnitude of the moves is likely larger in the former, though, I should say. Um, and there is then likely to be a large sort of degree of variation in market responses across different currency pairs. So the dollar would rise across all currencies pairs in a red sweep, and see the dollar really strong. But FX carry trades is most likely to suffer in a Trump victory without Congress. And then if you look at Asian FX, that's likely to rally the most in the event of a Harris victory without Congress, while the broadest dollar losses would likely be in a blue sweep, albeit more limited than the dollar gains in a red sweep. Hopefully you're getting that and understanding that really. For specific trades in FX, just to mention Goldman Sachs, actually, they've said, and I know this is a very common theme with markets wanting to be long the dollar against the Chinese yuan, of course, against the Mexican peso, and against the euro potentially. Goldman Sachs reckons many clients are long dollar CNH via risk reversals, actually, to position for that possible Trump presidency. And they say there isn't a strong case for dollar CNH falling significantly from here. And they also like Aussie against the yen, and also dollar yen topside really on a Trump win. For a potential Harris win, then they like selling the dollar against the Mexican peso, really. They see favorable entry levels after the recent squeeze higher amid buying that they've seen from all client types in the last week or so. That includes actually hedge funds to position for a possible Trump win, and especially given Trump's comments throughout the campaign on implementing tariffs. Harris scenario, then euro dollar, that could rally around 1.5%, Goldman Sachs reckon, but think the moves would be larger in dollar Mexican to the downside rather than euro dollar to the upside. Hopefully that makes some sense. We'll probably be talking about it more again next week, but just giving you a flavor of really what's been happening recently in markets, and obviously with these all-time highs in the dollar, obviously earnings as well playing a big part, but just this feeling that Trump, even though those election polls don't necessarily say it, but certainly with the poly market sort of blowing out in a way, then that might have been skewed, as I say, but also just markets and hedge funds, different players looking at different ways of playing a Trump victory at the moment. Okay, let's now look at the ECB meeting from last week. Really important meeting, really interesting because, well, monetary policymakers in Europe really beginning their own pivot, if you like. Growth continuing to disappoint. So as expected, the ECB delivered back-to-back 25 basis point cuts, noting negative surprises in activity and inflation data, and really the balance of risks for inflation skewing to the downside relative to previous projections. We've got in this infographic. We used it actually last week. We've kind of updated it a little bit. So hopefully that's of use to you guys. Um, as we put here, and as expected, though, guidance was unchanged, implying a kind of lack of pre-commitment for the next meetings in December and later meetings after that. So ECB still says it's data dependent and will act on a meeting by meeting basis. At the follow-up press conference, Lagarde noted that there will be a lot more data available before the December 12 meeting. And that suggests, again, they're kind of not on a preset expectation over what happens at that meeting. Lagarde also stated actually that she has not opened the door to another rate reduction in December, but she noted, of course, that there is no question that policy is currently restrictive. Markets kind of have looked through that from a Lagarde, really, because pricing sees pretty much baked in another rate cut in December. Apologies, I haven't updated that number there, but 25 basis point pretty much seen in December, and then sequential 25 basis point cuts after that, with around 115 basis points of easing seen in 2025. So you think that's probably 4.5 more rate cuts in 2025. Apologies for not updating that column there. But yes, 25 basis point cut money market C in December, pretty nailed on. And then, as I say, a further 4.5, 25 basis point cuts in 2025 next year. In the wake of the meeting, we did get sources stories. We always point this out, actually, just because it's interesting to hear what these stories say from Bloomberg, from Reuters, just kind of reaffirm the message after the press conference and the meeting. Essentially, they said if ECB officials do see a December cut, very likely, with the 2% inflation goal near. All it would take really is just the data to continue in the direction that it has been traveling, and that's bar any major rise in sort of core or services inflation or indicators of economic growth, which really are not very likely at the moment. They do add, actually, and it's worth adding, of course, the US election, threat of fresh trade tariffs. If Trump is elected, that would be, of course, a major source of uncertainty for the Eurozone. If we just look at euro dollar actually now, and I just want to mention, well, just before I bring that up, yeah, here's the euro dollar chart, of course. Consensus now, so after that meeting, really, and I touched upon it, really, is that, yeah, the ECB will carry on with back-to-back 25 basis point rate cuts. There is a chance, actually, around 20%, around that mark, just maybe a touch lower. I think it is around 20% of the ECB actually accelerating to a 50 basis point cut in September. That's probably not the base case at the moment. But of course, if there is evidence that the euro area is set to enter a recession and unemployment rise, or if inflation is sustainably at or slightly below the 2% target while the economy is stagnating, then that potentially would see the ECB deliver a 50 basis point cut. Certainly in that first scenario, if you like, of the euro entering a recession, then yes, the ECB would want to turn monetary policy, that their stance accommodative. So that would be one instance. And then that second scenario, inflation sustainably below target, then the ECB would aim to bring the policy rate to neutral more quickly, basically to jumpstart growth and avoid the potential undershooting of inflation. Besides the pace, then potentially there's a risk that the neutral or the terminal rates, that's where we end up at, are below actually the 2 to 2.5% range estimated by the ECB. The incoming data flow, we can't stress enough, will be critical. And in that light, of course, the PMIs, which we'll look at shortly, will be key. Last week as well, we did have that final September inflation reading, and it was actually revised lower to 1.6% from 1.7%, I believe. And the details suggest underlying services inflation is finally easing as well. So all points to back-to-back rate cuts. As I say, you can see that in euro dollar really as we sort of struggled around 112, then 111.39 was that high in late December last year. And we moved lower. If you call that a double top, actually, of about 200 basis points, then we should really drop to 108. If you see the sort of measured move. So the neckline around 110, just to make it easy, top side 112, that's 200 pips. So if we've now broken that neckline, which we have, 200 pips lower from 110 is 108. And you can just see last week's low was at 110, 108.10, I believe. Just checking, yeah, 108.10. So we're just sort of around that. We're around this Fibonacci level as well at 108.32. So just watch now whether we do get some support here. The black line is the 200-day moving average at 108.71. So really big level really would be around this 108 level. Tallies with that sort of low from August, although that was a touch lower than that. So yes, really interesting level now for euro dollar. If we do hold it, then yeah, upside 108.71 is a 200-day moving average. Hasn't had that much relevance, you can see previously. Otherwise, if we go for Fibonacci levels, then 109 would be a clear level, which is the halfway point of this move higher from the April low up to these highs in September. Okay, we'll just move on to UK data now. And just let me show you the infographic. This should be updated of the data from last week, of course. Big numbers for the UK, big data week. Middle of the month, again, we always say, always has a plethora of UK data, really. So we had inflation, we had wage growth, and we had retail sales, of course. Inflation, the key one, surprised sharply to the downside. The headline 1.7%, consensus was 1.9, and the prior 2.2. And then core, that came in at 3.2 versus consensus reading of 3.5, I think, and the prior was 3.6. And then the key services number, that came in at 4.9%. Consensus was for a reading of 5.2 and the prior 5.6. That's actually the below 5% for the first time since May 2022. And that is really big news for the Bank of England. We've consistently said this. Of course, watch the headline, but the key number for policymakers is the services inflation number. That now for Q3 actually stands at 5.2%, and that is notably lower than the Bank of England's forecasts at 5.5% from the August Monetary Policy Report, the MPR. Just to highlight this, or just to reiterate, actually, service inflation, that's the most important input for the decision-making process, because essentially it tries to gauge the level of inflation persistence in the economy. If you remember, persistence was a key word for Governor Bailey and other officials on the MPC for many, many months previously. Essentially, services sector price trends are slower moving, and they tend to be more reflective of domestic economic conditions like wage growth. So that is why services inflation is a key number. Otherwise, the decline actually was broad-based across categories, with core services, which strips out more volatile items, also falling substantially from 4.9% to 4.6%. And this downside surprise really does or should give the Bank of England more confidence, really, that underlying inflationary pressures are easing, and by extension then paves the way for rate cuts at the two remaining meetings for this year, November and December. And market pricing really adjusting to this now, nailed on really for a 25 basis point cut in November, and I think there's around 23 basis points of cuts in December as well. Remember, from a policy perspective, Governor Bailey, he earlier this month suggested the Bank of England could increase the pace of easing. Markets then may be tempted possibly to price in a bit more than 25 basis points for November. Now that services inflation has fallen below 5%. Remember, he said there could be a more aggressive rate cuts if inflation continues lower. And that is certainly what we have seen. One caveat to this, I should mention, is the fact that headline inflation, well, it did fall further, as I've said, but is likely actually to pick up. So likely to climb back above 2% and back towards 2.5%, 2.7% around the turn of the year. And that's almost entirely because of the drag from falling natural gas prices. That drag will be fading. Just a caveat in case you're looking at the headline, but again, just look at the services as well. We also had labor market data. Unemployment moved lower actually to 4%. Wage growth, important number, actually excluding bonuses, that was in line at 4.9% from 5.1%. So sliding slightly. Again, a small caveat with the employment data, especially the unemployment rate. It's poor quality data. They've had issues, the ONS Office for National Statistics basically collecting this data, and that's why the MPC don't put too much focus on it, and they look really more at a range of indicators on the labor market. Let's just get sterling up then, which is here. This is cable, of course, so sterling against the dollar. As I say, the chances of a 50 basis point cut, let's just mention that, are low at the moment, but potentially, yes, it depends on obviously the data going forward. There's greater flexibility of pricing to the dovish end, really, and then paired with just the bigger picture of the UK budget and also, of course, the US election. If we get defensive positioning into that, then potentially that hurts sterling against the dollar for sure. And then potentially we get trading below 130. You can see we've got a big Fibonacci level in there, which is really important to us. You can see it cap the upside, cap the downside, and then at the moment it is capping the downside again. That's the 38.2 of this move from the April low up to those highs in September above 134. So that's at 129.95, 130, let's call it. So that's a big area of support. You've got the 100-day moving average, which has sort of held levels recently as well. That's at 129.59, you can see there. Otherwise, if we do break down, then probably halfway point, look at that, that's at 128.62. So interesting levels for sure in cable, sterling against the dollar. We do like euro sterling as well. We've pointed that out in some of our daily market commentaries, and you can just see really interesting level here. We go back, you can see it's a long-term low from, where are we? August 2022. We dabbled with it and we just bounced off it previously, and now we're below it, but we're trying to sort of hang around it. 83.39 is that level, and euro sterling with that candle, you can see from Friday being relatively bullish, really. So a rejection of those lows and a breakdown much lower. Actually, that low from Friday at 82.94, spot 82.94, that is. But then we finished higher on the day, and you can just see we're trying to just get above. Obviously, 83.39 is sort of a zone now of support in euro sterling. Okay, we also very quickly, we're spending a lot of time here, but hopefully this is of use to you guys. Obviously, if you do have any questions, then please do ask them. Just looking at Kiwi inflation, that came out last week as well. That dropped to 2.2%. in Q3 from 3.3% in Q2. First time since March 2021. Level has returned within the target band of the RBNZ. That's 1 to 3%. Higher rents actually were a big contributor to annual inflation. They were responsible for half of the quarterly 0.6% increase. RBNZ, they expect inflation at, they expected it at 2.3% in its August monetary policy statement. Inflation returning to target probably will convince the bank it can further reduce policy restrictiveness in order to support poor growth. Markets, they discount another 50 basis point cut actually at his November 2027, November 27 meeting, 27th of November, that is that meeting. So markets discount another 50 basis point cut there, and more likely that is looking likely, with non-tradable CPI back below 5%. There is even a chance of a 75 basis point step, but that would probably require a dovish repricing in Fed expectations as well. You can see Kiwi has suffered actually recently with these rate cuts now being priced in, suffered at 63.69, that high from late 2023. We sold off very sharply actually down to the 200-day moving average, that black line, and we're still below there. You can see the fib levels again. We're on the 61.8, so a big level, really retracement level. That's at spot 6051, 6051 we call it. If we do break down lower, then the next fib level's at 59.62. And it's not looking so good at the moment. That recent low though at 60.38. That's the Kiwi dollar. And then in Japan, let's just pull up dollar yen as well, just quickly. We had, CPI data actually on Friday. As well on Friday, we had actually the largest labor union group that emphasized that it would seek wage hikes of at least 5% in 2025. As wage gains are yet to take root, is what they said. So going forward, those will be key. Wage negotiations will be really key to follow to assess the scope of further rate hikes from the Bank of Japan. Inflation, though, that did come lower. The BOJ's favorite measure, that CPI excluding fresh food, that declined to 2.4% in September. But those wage increases, the Rengo negotiated in the spring, 5.1%, that will probably be hard to repeat, but really wage growth above 4% will keep the door open for further BOJ hikes. Probably not, certainly not in this month, but potentially in December, depending on the election, of course, US election. Also, we get the LDP and the national elections this weekend. Should mention that in Japan. Probably won't change the BOJ, of course. But going forward, yes, December or possibly then January is expectations. I think consensus forward a BOJ hike. You can just see then dollar yen just pushing higher, really tallies with those 10-year US Treasury yields, which have pushed higher, of course. Correlates highly, this major, with 10-year Treasury yields. So just note that. We've got this sort of long-term level here, which we dipped below, of course. So possibly some resistance there. That's around 150. We've got the 100-day and 200-day moving averages just above that, and then support below, which is a long-term Fibonacci level, which we like to use, of the 2023 low up to this year's high, of course. Fibonacci level 148.68 is a big level for us. If we do push higher, then certainly you've got the 200-day moving average at 151.31, and then you've got a long-term high at 151.94, which capped the upside, of course, previously as well, an intervention level. That's dollar yen. Okay, quickly, because we're kind of going over what I said we would. But let's quickly go to preview of this week's main events, of course. Firstly, The Bank of Canada meeting, that's on Wednesday. Then we'll briefly look at PMIs as well. You can see rate cut expectations for the Bank of Canada. Basically, a 50 basis point cut is expected on Wednesday, would take the rate, overnight cash rate, to 3.75%. Most analysts see that, although it is slightly split. I think 19 out of 29 analysts surveyed by Reuters see a 50 basis point cut, and then 10 out of 29 see a smaller 25 basis point cut. We do get the latest monetary policy report as well. Just stepping back, recent remarks from Governor Macklem said, a week after the Bank of Canada cut by 25, that he stated that bigger cuts are possible if the economy and the CPI is weaker. The August data was soft, which really started 50 basis points being priced in with more certainty, although the strong-ish September jobs report, that saw really a coin flip really between 25 or a 50 basis point cut. But then we had the inflation data that was notably softer than forecast. And then really the 50 basis point cut bets ramped up. I think there's around 45 basis points of cuts actually. So really money markets see a much more higher odds than the consensus analysts that I said. That means around a 90% chance of easing of a 50 basis point cut at this meeting. The statement will be eyed for guidance and how the Bank of Canada are explaining the recent soft inflation data. Plus, of course, there'll be focus on the MPR, the Monetary Policy Report, for the Bank of Canada's economic forecasts. Ahead, or looking ahead, business sentiments, that remains subdued. That was recent figures, while excess capacity is leading to restrained investment and hiring. That was in the BOC's Business Outlook survey. And then firms also expect both wage and price growth to soften further. So just watch out for that, whether inflation moves lower and undershoots actually in Canada. Also looking ahead, that Reuters poll actually found that there was no clear consensus on what the Bank of Canada will do at the December meeting. 10 of the 29 analysts, they think we see another 25 basis point cut to rates then to 3.5%. But then 9 see rates stay on hold at 3.75%, and then 1 saw actually rates at 4% because they only see a 25 basis point cut on Wednesday. For the loonie, if we just pull up the dollar CAD chart, which has ramped higher, just bear with me 1 second, and you can see it here. Any hawkish surprises, of course, by the Bank of Canada, that would, of course, give a much needed boost to the loonie. It's depreciated about sort of 2.6%. Against the dollar since or from its September peak. So that's the low in dollar CAD, of course. Any hints about future cuts will be important, but certainly if Macklem keeps the door open to further 50 basis point reductions, that would put the loonie at risk, of course, of a deeper bear trend, which means then dollar CAD goes higher. Of course, the flip side, if he sounds slightly more upbeat, or if officials are wary about cutting too far too fast, then investors' markets may price out some of the rate cuts in the months ahead, and that would give a lift to the loonie as well and see dollar CAD fall. You can see levels here. We've got very short-term fib level in here, so 137.45. That's a level which supported prices earlier. Last week. Otherwise, if we break to the top side, then you can just see we're into sort of, very high levels really here. You've got this level 138.46 from April, and then the high from November last year at 138.98, ahead of that spike high from August at 139.46. Okay, that's dollar CAD. Finally, if we just touch upon the PMI data, just briefly, if I just show you the matrix, this is courtesy of Reuters actually, but a really handy matrix which you can see blue numbers from previous readings in October 23. You can see the blue is basically contractionary territory, that's sub 50 readings, whereas the brighter reddish numbers are above 50, which denotes expansion. And you can just see, just gives you a nice guide really of global PMIs and how we've moved out of the sort of contractionary territory actually everywhere really, apart from the Eurozone, which we did do briefly, and then we're back into that. So the Eurozone, as I say, still lags other regions. For the numbers on Thursday, expectations are for manufacturing in the Eurozone to rise very tight, very modestly. Services also to pick up. So manufacturing still very, very much below 50, 45.1 the reading expected. Services is above 50. That's 51.5 expectations, but then it leaves the composite still below 50 at 49.7 against the previous 49.6. There is scope for some stabilization on manufacturing, possibly due to Chinese stimulus efforts, but services sector may be hampered by news of French tax raising measures. And then from a policy perspective, as we kind of mentioned, the impact on the October meeting for the ECB, that was very important. So this is really top tier data for ECB watchers for the Eurodollar as well. And particularly given now the importance, the increased importance really of growth for the ECB. Really, then, if we do get a soft release, that could see acceleration of WS pricing for the December meeting. That would mean possibly pricing in a 50 basis point cut, which, as I say, odds are around sort of 20% at the moment. So certainly a really weak reading there in the PMIs on Thursday could see that and see the Eurodollar dip lower again through 108. We also get UK PMI data on Thursday. Expectations for services to slip slightly, while manufacturing also will edge lower, but those are still above 50. That means the composite possibly steady, but slips possibly down to 52.4 is the UK number from a previous 52.6. The last and recent data actually in the UK suggest really, though, that the economy is still on a positive trajectory. And it's quite an optimistic picture, really, if you compare that to the Eurozone. And that's obviously why you've seen Euro sterling at those levels that we have pointed out. Of course, there are some concerns about the upcoming UK budget. That's next Wednesday, the 30th. But possibly that could be a sort of rumor fact type thing, we think, because if the fear of fiscal tightening turns out to be greater than the net impact of what will be announced, then potentially that could help the feeling around sterling, of course. And we could then be in for a rebound in the PMI data in November. Policy from a Bank of England perspective, 25 basis points but baked in for November. A strong report could temper expectations for how fast the MPC will move after that meeting, probably for December and going forward. Also, we should just touch on the US PMIs just briefly. They are important. Potentially then it could extend the streak of upside surprises, and that would help the dollar actually potentially climb to fresh highs against its peers. Although the Fed, of course, is widely expected to trim rates by 25 basis points in at its next meeting in November. Just to reiterate, just before we go, actually, that first week in November, well, the first Friday you get non-farm payrolls, and then the week after, Tuesday sees the US election, and then Thursday, November the 9th, sees the Fed meeting and also the Bank of England meeting as well. So just put those on your calendar, and we definitely look forward to that week or the start of November for sure. Okay, I'll wrap it up there. Very long webinar. I do apologize, but really, really good to have virtually all of you actually on stuck around for 54 minutes. I really do appreciate that. And hopefully it's been of use to you guys. I don't see any questions actually, so um, please do follow us on social media. We do also have a daily commentary on the website, which we post after the US close, which has just a rundown of currencies, of stocks, and also looks at the day ahead and has a chart of the day. We will be back not actually next Monday, but next Tuesday, as I'm away actually in the US. So, yeah, please do tune in again Tuesday next week, and we will speak to you then. Take care.